Okay, hello everyone, and welcome to the second seminar series of our CreditWise Academy. Thank you for joining us. Today I'm joined by Prudence Chang. Hello,
Nice to
Prudence.
see you guys. Nice to see you guys there.
And also I have Paul Miller here, who is our resident PPS expert. Welcome, Paul.
Thank you very much.
So today's series will be working on the implementation and risk products and essentially what security you can seek from your customers when you're trading on credit. So first of all, welcome. The whole idea around our CreditWise seminar series was to empower your minds and inspire excellence in the credit world. And today we'll give you some tips and tricks and some knowledge that we've experienced over the last 30 odd years in our best practices that we see with our clients and our suppliers and our insurers in the credit world. Now, just quickly to recap Seminar 1. So what we tried to focus on in Seminar 1 was when you open an account or your first dealings with your customers. So this surrounded around the reasons why you would offer credit rather than cash trade to your customers or prospects. We looked at the importance of managing your credit risk and really around opening an account and using correct terms and conditions and how you would go about onboarding a new customer. Then we highlighted the credit risk management 101 and mainly around the credit matrix of how you would conduct an assessment with a new customer at different bands or different credit levels that you might offer. And lastly, we talked about building the foundation, and that included making sure you had the right terms and conditions, how you would write back to your customers when you open a new account, make sure that they know what credit limit you've offered them, and also what your terms of payment are. So that was the first seminar that we ran, and today is more around the security. So I'm going to hand over to Prudence now to talk about the three components that we believe the elements of security that we would offer. Oh, and by the way, I was meant to mention that at the end of this seminar, we will be running our Q&A session. So if you do have a question you would like us to answer at the end, please put that into the chat box and we will look to answer all of those at the end of this seminar. Over to you, Prudence.
Thank you so much, Kirk. Nice to see you two sitting there. I wish I was there joining you, but I'm in sunny Melbourne today. Firstly, I'd like to thank everyone, of course, for joining us and for all of your great feedback. We really appreciate it, and we're very excited to be here today. So as Kirk said, we're going to go through some securities. So the three things that we're going to be really concentrating on today are first guarantees. So there's a couple of different guarantees that we see out in the market that are being used as best practice. So I'm going to go through those. Kirk will go through credit insurance and what that means to a business. And of course, Paul is going to be going through our PPSR, which is still the bane of a lot of businesses' existence. So we are here to solve those problems. If I go to the next slide, please. So let's talk about guarantees. In the market, we see a lot of different guarantees, but most commonly on commercial contracts, we see a director's guarantee and what we call a cross-company guarantee. So for those that don't know, a director's guarantee is essentially a document signed by either one director or all of the directors of a company, which guarantees that they will be personally liable for any debts that the company actually incurs. If the company does not, in fact, pay, that means that you can have access, of course, to assets and anything else that can be within those directorships to actually repay those debts. It's a very, very strong position for you guys to have. And director guarantees really help you because it gives you that alternative party to pursue if the company does not wish to pay its debts. Such contracts are really, really easy to arrange. The only requirement is that the directors must be willing, of course, to place themselves in this position. It's a really good idea to have conversations with directors before they actually go to sign these, and especially if they do feel a little bit reluctant to, of course, sign them. If a director is not going to be willing to really protect their company's position, then I also do wonder what's actually going on inside. So it can open up other conversations to be had if they aren't willing to, of course, sign them. The clauses that you might want to be looking at are certainly all monies clauses and clauses that do put you in the best position. If I could get the next slide up so that we can actually have a look at what this might look like. So here you can see is a deed of personal guarantee or a director's guarantee. The clauses that we really want to be looking at are the ones that really protect you guys and really give you the liability, the fact to go after the liability of the directors. We want that all monies clause, of course, to be in there. That secures your debt as an all monies or an all securities clause. And this means that any security interest or guarantee will be cover the amounts that the debtor owes under the creditor for these arrangements, including future arrangements as well, which is really important. One of the great things about directors' guarantees also is that if the directorship does change, they still actually can be liable and they need to notify you. So it is on them to notify you of any changes, which is just terrific. And we'll go through this a bit later, we want to be monitoring, of course, the directors and the companies against any changes as well, so you can be proactive in those discussions. So over in the right-hand side, we've also got a cross-company guarantee. And if we could flick to that slide so we can have a look at what that looks like. We do, of course, that's the second page for the parent guarantee. Yes, for the parent guarantee. Sorry, I'll get you to go back one. Okay, so here, as I said, secondly, we have a cross-company guarantee, and we see them being used more and more frequently. One of the things that we do see coming up as well is that if you do have credit insurance, if we do see a nil being placed, often we can negotiate with the insurers to actually say, well, what if we got a cross-parent guarantee in place? This really means that the parent company or another company within the group is willing to be liable for any debt that the company could, of course, have. So it gives you another opportunity to go after somebody else with a vested interest in making sure that your debtor is actually paying those debts. So we do see it coming up as quite a bit in the credit insurance market, and certainly we see them as being a very strong avenue for security and something that we should be looking at. Again, these are very easy to put in place. We do have experts within our business that we can talk to in relation to how they should be worded in a bespoke level for your business. And I certainly do suggest that if you do have any personal director or cross-company guarantees in place or any new ones going out to people, have them looked at least a 12-monthly basis to make sure that all of that wording is putting you in the best position possible to be gaining back that debt that is owed. So now I'd like to actually hand it over to Paul Miller. He's our expert, as Kirk said, in regards to the PPSA. Thank you very much, Paul, for joining us today and discussing all things security.
Thank you. I think it might be useful to everyone if we just started off with a quick poll question, just so we can get a bit of feedback regarding the level of everybody's knowledge concerning the PPSR. So I've got someone pressing buttons and putting a poll question up on your screen. So this will be quite entertaining for me.
So while we're getting the results of people's knowledge of the PPSR, Prudence, just back to your security option with regards to personal or cross-company guarantees. We're finding more and more days that directors or businesses are setting up a structure where assets of a company might be held by a holding company. And whilst the trading entity might be the one that you open credit on, the holding company has all those assets. And therefore, when you do a credit assessment, it's probably set up purposefully on the basis that the assets are in the holding company. So when you do those assessments, it is important to look at where the assets or the main holdings of those securities can be held. And hence why we would look to try to get those cross-company guarantees from the holding company or maybe the directors.
And also it's important to remember, of course, that these guarantees aren't just for one company that you're getting to sign. Of course, they may have signed this for many of their debts. So the actual security that you've got in place could wane thin if there is many people going after these guarantees. So although it is a strong position to have, there is still an element of risk because it can actually be watered down quite significantly.
And I know if I was a director and I had a company and I had given a director guarantee to a particular supplier, in the event there was some financial stress, I'd be making sure that my company's paying those suppliers that had my personal guarantee before perhaps others. So anyway,
Absolutely.
thanks, Prudence. Well, back to you, Paul. We've got the poll up there. So let's have a look at the results. Quite a few people, 17% say they don't actually know what PPSR is. So you'll be covering that off shortly. 32% say, I know what it is, but we don't use it. So maybe you'll be able to educate on how they can use it a little bit more. 46% say that they use it, but they want more out of it, which is making sure that it is actually registered right, which you're covering off as well. And it's great to see that we've got 6% saying they're a PPSR expert. So they might give you a run for your money, Paul.
6% of people are going to keep me honest here. Stop me
Excellent.
from
I love
making
that.
stuff up.
All right. Okay, so we'll go to the next slide now. So Paul is our business analyst and expert. So Paul, hit us up. What is actually PPSR?
Okay, well, it's probably best to start with these basics. Firstly, what is it? Well, the PPSR is a register. It's a national, publicly accessible register that is based on a database for recording security arrangements, where those security arrangements involve security rights over non-real estate property. Okay, so it's a register for recording security rights. Now, it's important to emphasize that we're talking about recording security rights rather than creating security rights. Okay, a registration on the PPSR does not create a security right or a security interest in much the same way as getting a birth certificate doesn't make the baby. There's much more fun ways of doing that. So let's focus, or let's concentrate on the fact that we're talking about recording rights rather than creating them. Okay, so whenever we see something like this introduced, it's important to ask ourselves, well, what problem is it there to solve? Well, in the case of the PPSR, it was to solve a bit of a mess. We had something like 70 different registers across Australia recording different versions of different aspects of security rights being granted. The most common one was of course, ASIC's register of company charges, but there are also a number of other state-based initiatives that were recording various different types of arrangements, some very industry specific. So one of the things that the register was introduced to do was to harmonize all this, get it all under one roof. But the actual pressure for creating this type of register probably came from the finance industry. They were being asked to go into businesses and advance money for cash flow financing, long-term development, investment in new equipment, etc. And one of the first things a financier does is look around and sees what's available to act as collateral in a security interest. If the business folds, am I able to perhaps use, I don't know, their racking, their equipment, the nice shiny machinery they've got? Am I going to be able to use that to offset my financing losses potentially? And it turns out that without something like the PPSR in place, it was very difficult for them to understand what they could actually take as collateral in a security right. And it's important as well, I suppose, to mention that when a company went bust or insolvent, it was very difficult to understand what a liquidator's decision might be when it comes to who has the best right over the liquidated assets of this company. Was it the big banks that could shout the loudest, or was it the little trade credit supplier whose focus was very specifically on some goods that they had supplied? So whose right, whose priority security right would win out? And there was a lot of confusion about this. There still is, but at least the PPSR adds a greater degree of clarity and helps us make those decisions. Okay. So when should the PPSR be used? When should a registration be lodged on the PPSR? Well, certainly the best time to register something on the PPSR is early. soon and early. You cannot be too early when it comes to lodging a registration on the PPSR. You're allowed to lodge a registration on the PPSR when you anticipate that you might need it, when you might be entering in a new piece of business, when you might be opening a new credit account. You're allowed to lodge a registration in anticipation of that being the case. If it turns out to no longer be the case and not likely to be the case, then fine, you should be removing that registration and you might have wasted $10. But the important thing is to get your registration in soon and get it in early. And if you're looking to incorporate something in your credit processing arrangements, the best thing is when you get a credit application signed and you're starting to go through the process of opening up a credit account for your customer, then is the ideal time to lodge a registration. And you should certainly be making sure you have registrations lodged before you actually start sending out your goods to your customer. Okay. All this, of course, again, if you refer back to the first thing, which is the PPSR as a database for recording security rights. Obviously, if your terms and conditions don't include any security rights, then either you should be looking to make sure they include them, or you won't have anything that you can actually register on the PPSR. So have some security rights in your terms and conditions or in the contract that you're agreeing, and then register as soon as possible. So what happens if you don't? What happens if you don't use the PPSR? Well, in an insolvency situation, if you haven't lodged a registration to perfect, this is a jargon expression the PPSR uses, to perfect your security rights, then a liquidator will be within their rights to effectively ignore your security. Okay? Without a PPSR registration in place, you might as well not have your security rights. Okay.
So Paul, just to clarify, I'm not an expert in PPS. So let's just say I'm a plumbing goods supplier. I've received a credit application from someone who wants to buy plumbing goods from me. I've got the credit app, I've got security rights, like a retention of title clause in my terms and conditions. I've received the credit application signed. I then know they've asked me to send out some goods next week. It's $100,000 worth of plumbing equipment. I register that on the PPSR, and then I've perfected my security interest.
That's correct, yes.
All right, there we go.
Absolutely.
I'm not as dumb as I thought.
No.
Excellent. All right, great. So tell us, how do you go about it?
Right. This is one of those occasions where everybody is different. The most common form of security has just been mentioned by Kirk here, is a retention of title right. Now, I know people don't like looking through their terms and conditions of trade. They're written in very small writing. They often use legal language that's not necessarily the easiest to understand. But I would strongly suggest people take some time to look through and see what's in their terms and conditions, and see if you can identify the security rights that those terms and conditions are actually granting you. Sometimes there might be some helpful headings in there. And in this case, for trade credit suppliers, you're particularly looking out for a heading, something like retention of title. Now, there may also, if your terms and conditions have been looked at recently, there may actually be a heading PPSA or Personal Property Securities Act or something along those lines. But don't immediately look at that. Start looking for your security rights first, okay? Because very often they will appear on their own heading, on their own section, and don't just look for a section headed PPSA. So you're looking for a retention of title right. And at its simplest, a retention of title right simply means that the goods that you are selling remain yours until such time as they have been fully paid for. That means, in practical terms, that if they haven't been fully paid for and your customer isn't meeting their payment schedule, then you have a right to take those goods back. Now, without a PPSR registration in place perfecting that right, you effectively lose that right to take your goods back. Okay, so when we're looking at how to lodge a registration on the PPSR, we're looking at how do I lodge a registration to say perfects my retention of title rights. Now, we've put an example on the screen. Now, we've taken this example, a shameless self-promotion here for NCI. We put a bit of the NCI form on the screen. The only real reason we've done that is that NCI's form takes up 1 page, whereas to do it directly on the PPSR, I think that covers 3 or 4 pages of forms. So it's just easier to see it on the way NCI do it. Without anyone wanting to take, I mean, you can take a screenshot by all means, but I understand that we'll be issuing a PDF to any attendees showing these sorts of screenshots for you to look at later. So this is very much our indication as to how you should be lodging a registration, but I'll come back to this in a few minutes. First, I want to look at how do we identify who we're actually lodging the registration against. So Kirk, if we go on to the next screen. Now, unfortunately, along with a lot of very unfamiliar jargon, the PPSA has brought with it a lot of fairly detailed rules as to how we need to identify our customers. It would be so much easier if all the PPSR wanted was your customer's ABN, or perhaps if they're a company, your customer's ACN. We spend a lot of time at NCI advising our clients of the importance of identifying who the legal entity is that we're trading with. The PPSR has its own very specific rules as to how that legal entity needs to be identified, and for an added layer of complication, they also suggest that some not quite so legal entities also need to be identified. Hence, we have to look at the way in which, for example, registrations should be lodged when someone is acting on behalf of the trust. Again, this table is going to form part of a PDF that we're going to be issuing to attendees after this, but I'm just going to leave this up on the screen for a little bit longer, just so you can see that there are some very specific rules here as to how a registration needs to identify who it is being lodged against. Now, this isn't just a bit of government bureaucracy that you can sort of ignore because the spirit of the rule is far more important than the letter of the rule. Unfortunately, the letter of the rule in this instance takes center stage because there is already legal precedent in place to show that if those rules are not followed very, very specifically, then a registration will lose all its effectiveness. It just won't be less effective, it will actually be invalid. Because these are the rules that the PPSR uses to when you have to conduct a search of the register. Okay, so if you want to do a search of the register to see if a registration has been lodged against company ABC Proprietary Limited, you have to conduct that search in accordance with these rules. And if a registration has been lodged against, for example, the ABN of that company, instead of its ACN, then that registration will show no registrations, or that search will show no registrations, and your registration, if it was lodged against the ABN, will be deemed to be invalid. And that's just what happened a few years ago in the case where All Leasing hired out $23 million worth of equipment to One Steel Manufacturing. One Steel Manufacturing, back I think it was in 2013, had an administrator appointed and all found that All Leasing had actually identified One Steel Manufacturing by its ABN rather than by its ACN. And as a result, All Leasing's registration was declared to be invalid. This was upheld by the judge in court. And as a result, the administrator was able to turn around to All Leasing and say that their registration unfortunately didn't hold water and that their security rights had not been perfected. So it is so important to get those right. Now, talking about getting things right, we go on to identifying the collateral that you are identifying in your registration. Now, collateral is a very much a new term brought in by the PPSR in trade credit spheres. In trade credit spheres, we talk about amounts owing, we talk about debtors. Since the introduction of the PPSR, we have to talk about collateral now, and we have to describe collateral. So what is collateral? In PPSR context, collateral is what we have a right to take back in the event we're not being paid for. Okay, now if our security right is a retention of title right, where we have a right to get our goods back in the event they're not fully paid for, then our collateral is the goods that we are supplying. Okay, so when we ask for a collateral description, for example, we want you to describe in very general terms, very broad terms, don't be too specific here. We want you to describe in broad terms what it is you have supplied that we have a right to, or that you have a right to get back. Don't bother writing in goods and services, because this is a collateral describes property that you are entitled to get back. Services aren't property, and you can't get services back. So focus when you're describing property on what you are entitled to get back. And if anyone can tell me whether or not thingamajigs should be hyphenated or not, please do so. Agonized over that one. Now, the other key phrase you'll see on there underneath collateral description is purchase money security interest applies. Again, more jargon created by the PPSR, more things to confuse us. It doesn't really help that we abbreviate purchase money security interest applies to PIMSI, which is easier to say, but not really easier to understand. In our context, in a trade credit context, it's perhaps easiest to think of a PIMSI as representing two things. Firstly, it represents a super priority. It's something that gives you a greater right to get your goods back than, say, a bank's general overarching security right might have. Okay, it gives you the number one priority right to get your goods back. And the other thing to remember about a PIMSI is that it will always be applicable when your security right is a retention of title right. Okay.
So the bulk of our clients would be selling inventory. We talk about inventory next, or actual plumbing equipment or electrical equipment, lighting, all their different types of products. That's what they need to put into the collateral description.
Yes.
Yeah.
And we would, first off, we started recommending property supplied by the secured party, goods supplied by the secured party. But lately we've been seeing that a lot of liquidators, administrators, even other creditors want a bit more of a clue as to what we're actually talking about. So use this magic phrase, including but not limited to, if you want to be a bit more descriptive as to the goods that you're selling.
So, Paul, just in the interest of time, to keep going through, so all of these elements need to be ticked off in the template, or when you are registering, you need to think about these things. So back to your template here, essentially, this will lead you into those factors that we need to make sure that our client is thinking about, whether they want to register goods, collateral, the description that can be set up as a template, so they don't have to fill it out and make mistakes each time. the time period that they want to register that for, or the PIMSI. They need to tick all these boxes to perfect what they've got on their terms and conditions.
Absolutely.
Yeah.
All too often we see clients lodging or suppliers lodging a batch of registrations that all look perfect, and then lo and behold, we see a batch of registrations where boxes have not been ticked because people didn't understand the question, and there's been a change of personnel at the company.
Yeah.
Someone's gone on maternity leave. The replacement didn't really understand. They only lodge registrations once in a while when they get a new account on. So there are all sorts of reasons why it's a good idea to have it decided up front. This is how we want to lodge our registrations in the future. So what we do is we set up a template for you, and we effectively pre-populate the way you should be lodging your registrations.
Excellent. So any other last minute tips you can give us about the PPSR? What would you suggest people do in the first instance?
Make sure you have a security right to register, make sure you register promptly, and make sure you register accurately.
All right. Thanks, Paul. That's been really useful. That's a lot of good tips there. So just moving on to another type of security that people can look at. I guess when you look at a business and what they do secure or what they insure, most businesses will protect their cars, their warehouse, their stock, to make sure that if they're stolen or it burns down or something like that happens, they're insured and they're going to be able to recover the cost of, or the majority cost of that asset back, so they can build another warehouse or get more stock. What sometimes people don't think about is what possibly could be their largest asset, and that's their trade receivables or their debtors that they have within their business. And you can think about how many invoices that you issue and the level of asset that you have out there and for your cash flow with your customers. That typically will be one of the largest assets that you have in your balance sheet. So many people around the world decide to take trade credit insurance as a specific security over their or the risk of one of their debtors not paying them. And that's what NCI are experts in. Unfortunately, despite all the efforts that a company or the credit teams do, unfortunately, insolvencies do happen and you do have a bad debt. And trade credit insurance can be that comfort factor or the safety net that's there for you, that if one of those events do happen, you'll be secured up to, say, 90% of what you're owed to get back from trade credit insurance. So how does it work? What's the benefits of trade credit insurance? So it protects you against non-payment or insolvency of one of your customers. So it's one of those last resort type things. Whilst you've done everything possible you can leading up to this event, you've got your PPS registration, you're trying to get your stock back or whatever. If one day you just receive the administration notice or a liquidator notice, that's when you speak to people like us and it kicks in under your insurance policy. One of the things that people don't think about is that when you do have a bad debt, it's cash flow that is going to impact your business immediately. Yes, you might have a bad debt reserve and you can write that off, but you're also going to have, if you've bought those stocks from your suppliers, you're going to have to pay your supplier still, and a provision's not going to cut it. You're going to need that cash flow back. And that's one of the things that you can sleep better at night, knowing that if one of your debtors become insolvent, you can get that cash flow back from your insurer, and then you can pay your suppliers easy enough. It's going to protect your cash flow. It's going to add security to your business, like we mentioned. And one of the additional things that it will do is strengthen your credit management, because we can give you additional information on customers that you may not be privy to. So when you do apply for a credit insurance cover on one of your customers, we might already have overdues or information on file that we can say, hey, we're not sure if you really want to deal with this customer. We've already got some adverse history on it. Or we might be able to say, hey, this is a green light. You should be dealing with this customer. You can actually have more credit if you want, sell more to them, and that can help with your cash flow and selling more in your business. And the last thing that we'll highlight is that many of our clients use their security of their trade credit insurance policy along with their debtors ledger as going to their banks or their financiers and getting more security or more cash flow to help them in getting more funds for their business. So let's just have a look at how it can work. So if you're the supplier and you have a customer and they want a $50,000 supply of plumbing equipment to them, that's where you'd get cover on your customer. You'd then come to your broker and say, hey, I want to insure that. Can you go out and get some quotes for us? We'd go and do that for you. I've got an example there of if that customer then became insolvent and your $50,000 invoice wasn't paid, the administrator's been appointed, let's just say at an average rate of 0.3% of that 50,000. So for $150 premium cost, we'd be able to get approximately $45,000 back to you in the event of that customer becoming insolvent. So knowing that, what would give you peace of mind? Would you sleep better at night knowing that for that small percentage, that in the event that that customer did not pay you or became insolvent, you could be getting that return back from your insurer. So that's a basic of understanding of how trade credit insurance works. Now, there's a number of different ways to go about it, but typically the 3 bits of information that we would need as a specialist broker to go and get some quotes from the different insurers that we've listed there. We would need to know what your insurable turnover is, so what your credit sales are, who your major customers are, and what your major credit limits would be with those customers, and your bad debt experience. What sort of bad debts have you had over the past 3 years? And would that influence what the quotes might be? They're the basic 3 bits of information that NCI can get from you and give you a pretty quick quote back about what we could do to protect your business. So then I'll hand back to Prudence. Now, this isn't necessarily an actual security, but it is another layer of protection that you can do in managing your security and the debts that you have out there. Prudence, why don't you tell us about monitoring your customers?
Absolutely. Thank you so much. So I hope what everyone's getting, as I'm getting from listening to everybody, is that this is a layered approach. You want to, of course, open your accounts in the best manner possible. We want to have those additional securities being the director personal guarantees and possibly the cross-company guarantees. The PPSR is there to, of course, grab your goods back, which everybody wants. There's nothing worse than not being able to get what you've actually manufactured back and you've spent all that time on. But really, before this all happens, we want to be opening those accounts and then watching those accounts. So I liken this to a bit of a picture. You take a picture on a camera of an account the day that you open it. Unfortunately, just like all pictures of people, the company changes, people age, and the situation also changes. Now, unless we're looking at that picture on a daily basis and retaking that picture, we're not going to necessarily understand or know if the financial worthiness of one of our debtors has changed. It's really important to seek out a monitoring service of some type. This monitoring service should look at changes on ASIC to do with the company, but also to do with the directors. See if they're being associated with any payment histories with any other businesses or any past failed companies. Of course, we want to be watching the payment histories and what they're actually doing so you can monitor that internally as well. So watching the daily sales outstanding figure for each debtor and seeing if they do start to pull out. If they do start to pull out, it's important that we're doing something, of course, with this information. And my advice would be to give a call to that debtor and say, look, we've noticed that you're paying a lot later than what we've seen in the past. What's happening? Allowing you that best position to then decide what you want to be doing with that debtor. Of course, we want to check customers and see if they are exceeding those credit limits and monitoring that debtor. Why are they actually exceeding those credit limits? Is there something going on that you want to be aware of? Now, I would also say that if they are exceeding those credit limits by any more than 10%, it might be wise to relook at that account and have a look at the situation and see if they're worthy for those growths in those credit limits being raised. Now, external alerts, early warning signs, they're so important. It's great that we find out that a company's gone under, but it's after the fact. There's not much you can do about it. I personally like the proactive information. So information such as they're running slow with other creditors. They could be on stop credit. They could going into repayment plans. That type of information from a monitoring component is invaluable for you to be making those right decisions within your business. Now, of course, we also want to see the debtor's financial situation. You may not be getting, financials off them on a yearly basis, which is quite normal. But people that can actually organise monitoring services, such as ourselves, we do look at those types of documents to be able to better inform you of the situation of your debtor. So what's involved with setting up monitoring? It should be as easy as handing over an ABN, ACN number and going off to an adverse service that has got a holistic view of all of these areas to provide you with the best position possible to be monitoring that photo moving forward. So this is another layer, as I spoke about before, a proactive layer that can be done before actually having to engage in any of these situations where we're talking to directors about issuing these securities. And it puts you in a better light to also be negotiating for new business. Because if you do see that those credit limits, as I said, are being raised or they are asking for additional goods to be sold to them, then it might actually mean that that debtor and yourselves can work with each other a lot better moving forward. Next slide, please. So we also wanted to show you something that I think is invaluable for businesses to look at, and you can just get this through the NCI website. We do have the information there. This is the NCI Risk Index. The NCI Risk Index score is based on aggregate of claims data, collections activity, limit and credit limit increases and decisions, and overdue accounts. So as you can imagine, having such a large amount of data information, we like to give that information back to you guys so that you can make better decisions within your business. As we have such a huge amount, it is really great for you to be deep diving even further. You can get industry information as well. But what it's really there to do is to provide a prediction on not just the economy, but how your industry is going in regards to payments and any pain points that may be seen in the next couple of months. I hope that these figures aren't too alarming, but I do have a few facts for you. Of course, we've received 1,131 collections, 424 claims have to the value of $32.4 million. And this is actually an increase of 1.6% on the value of claims that have been lodged in the previous quarter. Those increases we do suspect will continue, which is why it's so important to have these layered securities moving forward for your debtors and yourselves to be working well together. We've also seen that 392 claims have been paid in the last quarter with a total of 19 million. And our largest claim state is New South Wales. You guys are quite popular with 39%, followed by Victoria at 26%. And they are normally where we see those figures coming out from. And certainly if you do have a large sway of debtors into those states, it is something that we should be monitoring moving forward. So certainly for more information on the NCI index, our details will be at the back of this presentation. But it is available on our website, so please go have a look, register yourself so you can get this free information from us.
Thank you, Prudence. So I guess we're coming to the end of the seminar, but I guess the question that we would ask yourself is that if not all customers are going to pay you, what else can you do? And whilst you do everything possible in your credit teams and your businesses to make sure you get paid from your customers and set everything up right, today we wanted to talk about the security side of things and what you can do just to add those additional layers in. In the next seminar, seminar 3 and the final seminar of this series, we'll be talking about how we go about the recovery process if someone doesn't pay you. Just some tips and tricks of what you can do in preparing for receiving payment and chasing up payment to legal action in the event that you have non-payment. That will be our 3rd webinar series coming up soon. And you can register that by using the QR code there or going onto our website to register for the 3rd one. But now what we'll do, our expert panel here, Prudence, if you've got some questions there that you can ask away, I think we saw that we had a number of questions there. We'll try to do our best in the next little while about answering all these questions. So Prudence, hit us up.
Thank you so much. We do have a number of questions. Thank you very much for entering them into the chat. If you've got some more, please do so now. First question that I've got, Paul, regarding acquisitions. Do you need to resubmit PPSR so they reflect the correct new ABN, e.g. currently under the old owner's ABN, but should they be under a new company's ABN? And if customers are completing a new credit application, including new T's and C's, do we actually also need to complete a new registration?
Right. Firstly, it is of utmost importance that any new entity with which you're trading is the subject of a fresh registration, or is a subject of at least a registration. Now, that could mean that you lodging a fresh registration, or you could actually add that new company, that new grantor, to your existing registration by amendment. Very often that's a good way of doing it, particularly if you've got a sort of a transitional period going on, with some debts owed to you by the old company and some new ones being entered into by the new company. So having both on the same registration is obviously, or can be, a very good way to go. Just make sure you identify your company or the new grantor correctly according to the PPSR's rules.
Excellent. Thank you so much. Now, a question, I might answer this one. If only one director has signed the application, so we're talking about a director's guarantee, is this sufficient for securing? Yes, it is. So you don't need to have every single director sign every single guarantee. You can actually have one or all of them if you wish, but certainly one does secure the agreement. Back to
and Prudence, probably to add to that, I mean, this is where you should be asking for an asset and liability statement of perhaps some of those directors, because it might be all in the husband's name, all in the wife's name, or different partners have different assets registered in their name. So you can check that out by doing lands title searches to see where the assets are. I mean, ultimately, the more guarantees you can get from the directors, the better. But sometimes, obviously, at least getting one over a number at least is a start, but maybe just check out where the assets fall.
Absolutely. Now, Paul, hire equipment. How does the PPSR respond to this? Can you register the PPSR on hire equipment?
Okay. No one's going to thank me for going into a full answer on this, so I'll just do a brief answer. The PPSR has separate rules for goods subject to hiring. One of those rules is that the hire period must be for a long period, so it's not designed to capture very short-term hires or hires of only a few weeks or a few months. But yes, the PPSR does have special rules for hired and leased goods and equipment. If you are hiring and leasing goods out on a long-term basis, it's important to put a PPSR registration in place. You can do it as a PIMSI, as a purchase money security interest, and your registration should be able to attract the same sort of level of security as a retention of title secured registration would get.
Excellent, thank you. I've got another question here. All PAPs. We have an all PAP, happy to allow the bank to be first, of course. We clicked the subordinate and then we're listed. We now want to remove the subordinate so no one else can sit over the top of us. Once we do this, does the bank say that they still have to be first? What is your experience in that, Paul?
Right. First off, there is nothing, the word subordinate, I don't think appears in the PPS Act. It's an invention of the people that created the register itself. I don't believe it has any legislated meaning, and I don't think it particularly commits you to anything. So if you've ticked the subordination box by mistake, don't stress it. Best to delete it, but don't stress if you don't. Even if you have agreed that a bank or some other third party should take a priority over your registration, you still don't need to tick the subordination box in order to give effect to that. I have never had a situation where I've needed to advise anyone to tick the subordinate box.
Right.
And I suggest generally just don't bother.
Excellent. And in regards to trusts, I've got a question here. If I register PPR separately on a trust with an ABN And then do I actually register the entity behind the trust with an ACN separately? Do I need to
think
register?
that's best practice. Definitely
Best
best practice. At the very least, make sure you have a registration against the trust ABN. But what we also recommend is add to that registration. You don't need to increase your costs. Add to that registration the trustee of the trust, either by their ACN if they're a company, or by their full name and date of birth if they're a sole trader. But yes, definitely doing both is good business practice.
Excellent. And in regards to the PPSR, Paul, we've got a question here that it doesn't become valid for at least 6 months. So if a company falls under within a month of the PPSR being lodged, you're not considered secure. I don't believe that's correct.
It's sort of half correct. Maybe less than half, but it depends. It depends is the short answer. All my answers, unfortunately, to do with the PPSR tend to start with it depends. The Corporations Act basically lets liquidators, when they're appointed to a company, assume that the company had been insolvent for the 6 months prior to their appointment. Therefore, anything that company did in the 6 months leading up to that appointment becomes suspect. That's the whole raison d'etre behind liquidators being able to claim unfair preference payments, for example.
Right.
When it comes to a PPSR registration, if the registration has been lodged during the 6 months prior to the liquidator's appointment, and it was not lodged within 20 business days of the security agreement being formed, which the trade credit suppliers would be the credit application being signed, then the liquidator will have grounds to effectively ignore that registration.
I think what we find in reality there is that it at least gives you the opportunity to have the discussion with that particular administrator or liquidator, especially if they want to trade the company on for a little bit longer. It gives you skin in the game to be able to say, those goods are mine. I want them back. They haven't been paid for. I've registered it. If they are saying, oh, but hang on, we want to trade the company for a bit longer, we need those goods. You go, well, that's fine, but you've got to pay me for them.
Yeah.
It just gives you that opportunity to have a discussion with an insolvency practitioner. If you haven't registered or you've done it wrong, then you can't even have that discussion with one of those people. So I guess what we're saying here is there might be some technicalities, but we know through experience that we've had great success in speaking to insolvency practitioners or people that have come in to say, hey, we're going to trade this company on for a little bit. You've got a better position if you've got a registration than if you didn't.
Yep.
Yeah, absolutely. And best practice being that when they sign the credit application form and you've got those clauses in place that the PPSR can be registered as we've discussed earlier, that you're registering at that point. Rather than just waiting a month down the track when the salesperson's going, oh, I've got an order here and we need to send an invoice. Best practice that I've seen certainly is when we're actually opening the account to do it at the same time. Just open the account, do all your trade references, adverse reports, securities, and your PPSR registrations need to go on as one. So I've got a question here again, being, is the PPSR effective if dealing with a sole trader or a trustee company? Does it have the same effect?
It should do. They're clearly identified as potential grantors in the legislation. So yes, sole traders and partnerships and trusts, even government entities are identified as potential grantors.
Yeah.
And is there a clear distinction, Paul, between title and property rights within that?
Property rights are very much dependent upon title in this instance, but the PPSR is not a register for recording your ownership rights. The PPSR is a register for recording your security rights. So it's not just, I own this, I'm worried about someone taking it away from me. The PPSR is not a register for recording that concern. I'm using my right to recover this equipment as a form of security. That is a security right that needs to be registered on the PPSR. I'm happy to enter into separate discussions on this because it can be an awkward point, but we
Yes.
do see a lot of traders thinking, I'm going to be leaving my tools overnight on a building site. I want to make sure I can get them back, so I'll lodge a PPSR registration. That is not what the PPSR registration should be for. It's not something that a PPSR registration will help you with, because you're not actually hiring those tools out or leasing those tools out. So there's a time and a place for a registration. And just because you happen to leave your tools on site overnight or your equipment on site overnight is not one of those occasions.
And I've got quite a few questions around services. And there's always been a bit of confusion about, do they register services? Is there any benefit to registering a service? Can you just talk me through that? Because we've got some freight forwarders on the line putting through some questions that I think could be quite relevant.
You cannot register against a service. What a service provider can do, however, is negotiate with their customer a form of security, such as a charging clause can be quite common in these sorts of situations. A charging clause would say something along the lines of, we, the buyer, hereby put up all our personal property and real estate property as security or as an indemnity against non-payment of our payment obligations or non-fulfillment of our payment obligations. So you can have a form of security granted to you by your customer that has nothing to do with the services that you're providing, but the security right will be over what your customer is putting up as collateral rather than what you are providing as a service. So that's realistically the only way a strict service provider is going to have anything to register on the PPSR.
Okay, excellent. Question about commingling. We've had quite a few conversations, Paul, about this, and I've got a question in regards to a supplier of reinforced steel. Of course, this is buried in concrete with no opportunity of actually getting it back. Is the PPSR of any benefit to us, and does this come under sort of a commingling area?
There's a lot of new terminology the PPSR brought in: commingling, accessions, transformations. This is one of those situations where I think once something is buried in the ground and has had concrete poured over it, it effectively becomes real estate. Now, that means that a supplier's right to the rebar or what have you disappears. Okay, they no longer can get the rebar back. However, if their registration allows, and if they've registered correctly, it should allow their security rights to transfer from getting their rebar back to getting the proceeds back from whatever the builder that they sold the rebar to is able to get from effectively selling that piece of real estate. So there's a bit of a train developing here whereby there is a right to a share of the funds the builder receives that should be due and passed on to the trade credit supplier. Now, that's how it's supposed to work in theory. In practice, I appreciate it's a bit different, but the theory is there to allow security rights to transfer.
Thank you, Paul. I've just realised the time is 12:30. We've actually got another 40 questions that have popped through. So, Kurt, can I suggest that we put through a question and fact sheet to the attendees that have asked all these wonderful questions about the PPSR and certainly about monitoring and guarantees, and perhaps we only answer about one more question. How does that sound?
Yeah, sure. Like anything, everybody gets very interested in a lot of these different elements, especially on the PPSR, and that's why we do have an expert on our staff. That's why NCI offers these services along with other companies out in the marketplace. But we've got our contact details there. If you'd like to know more, then please send us a question. we can help you. Part of our service is that we've got people who can meet up with you or answer questions over the phone. So if it's not one of us, we'll make sure we get someone out to see you or to talk about these elements. We will, like last time, send out a copy of this to the people that attended. They'll also get a question and answers sheet with our questions and answers that we feel are most appropriate. That sort of will be sent out in the next few days. So that will happen. If you'd like to follow us on LinkedIn or Instagram, there's a couple of different places you can go to follow us. We do write articles when there are changes in trends, or our index gets loaded there, or if something happens in an act, we'll make sure we update it and give our opinions. Like anything, if you're looking at a legal document or a process, we also would get some legal advice on those words or clauses that need to be in your terms and conditions, but we can help with those also. And every business is different. So there's going to be a different box to tick, or a different collateral, or a different description that needs to go into templates. But we can help you with understanding what your business will need to do specifically if you ask. So I don't know if we've got one last question, but of course we'll send everything out shortly.
One last question I'd like to ask, because it has come up a few times, is preference payments. Paul, what is the position of having a PPSR as using security, and what relevance does it have in regards to preference payments?
Okay, good question. A liquidator only has a right to claw back payments made in the 6 months prior to their appointment if that payment was on credit terms and was unsecured. Okay, so secured creditors are safe. Secured creditors are safe, or they have a built-in defense. So in theory, someone with a PPSR registration should also be safe. However, the liquidator is going to make them jump through some hoops first. The liquidator is going to basically say it's all very well having a PPSR registration in place, but did the PPSR registration effectively reflect the security rights that you had actually been granted? Did you actually have a retention of title right, for example, in your terms and conditions? And also, if we're talking about a retention of title right, were there still goods there at the time you received your payment to get your goods back? Were there still recoverable goods there? Because your security right is over your right to get those goods back. If those goods had already been used up or unsold and weren't recoverable, then the liquidator will then argue that you weren't fully secured.
I guess one of the things, again, going back to the point that it allows you to have another discussion and now allows you to add another element back into your defense against the preference action. It makes the liquidator have to think about how they're going to be responding to you, and also prove that you knew that the company was insolvent, and the fact that you're adding more time and effort for them to respond to you with another element that you might be having in your defense of saying, hey, I was a secured creditor. They're also going to have to go and look at whether you've got those elements. So it might just add to your bargaining power or your discussions in your defense, and how much effort that insolvency practitioner may have with your organization in trying to continually go after you for a preference, or wanting to negotiate a little bit more on it. So it has the definitive action potentially, but it also has the ability to have a bigger discussion or confuse the element around a preference response when you're making a defense.
Absolutely.
All right. Well, thank you everyone for joining us again. Thank you, Paul. Thank you, Prudence, for your time. We really love you, love having you on this seminar. So thank you again, and we look forward to you seeing at the last seminar, seminar 3, about how you can recover your monies in the event that someone's not paying you. Let's bye for now.
Thank you. Bye.